Reverse repo rate is a crucial monetary policy tool used by the RBI to manage liquidity, that is, the amount of money circulating in the Indian financial system. It is essentially the interest rate at which the RBI borrows money from commercial banks within the country. When commercial banks have surplus funds that they do not need immediately for lending or other operations, they can choose to park these funds with the RBI. The RBI offers to pay them interest for these deposits, and this interest rate is called the reverse repo rate. This transaction is typically short term, often overnight, and involves the banks temporarily selling government securities to the RBI with an agreement to repurchase them at a predetermined price later. The primary purpose of the repo rate is to absorb excess liquidity from the banking system. When there is too much money floating around, it can lead to inflationary pressures as more money chases fewer goods. By increasing the reverse repo rate, the RBI makes it more attractive for banks to deposit their surplus funds with the central bank as they earn a higher return. This incentivizes banks to lend less in the market and park more funds within the RBI. Consequently, this reduces the overall money supply available for lending to business and consumers, helping to control inflation. Conversely, if the RBI wants to inject more liquidity into the system, for example, to stimulate economic growth during a slowdown, it might reduce the reverse repo rate. A lower rate makes it less appealing for banks to park funds with the RBI, encouraging them to lend more to the economy.